Well, if it feels like the gold and silver rally has cooled off, it's because it did. But is this a breather or is it something bigger? That's always the question. Well, I know what I think, but there are signs that we can all look for that are a lot better than any one person's opinion. Two things happened to gold and silver the past 2 weeks. The prices crashed and then they more or less leveled off. Now, technically, they didn't crash. They corrected. But we don't want to downplay the drop here. We just saw the biggest 2-week sell-off since June of 2013. Gold fell about 11%. Silver fell more than 15%. So if we're obeying semantics, a correction, it's 10%, a crash is 20%. Now, the actual impact on you or me as a physical buyer of gold or silver is probably theoretical. Most of us didn't buy at $4,350, turn around and sell it at a loss. Now, anyone doing that, they really only had about a week to pull that off. We didn't even see $4,000 gold until October 7th. So unless you are actively trading, you probably weren't financially affected. The psychological impact, though, that's different. And before we take that further, quick shout out to channel sponsor Summit Metals. If you're looking to buy gold or silver, they have you covered. And hey, if you're looking to sell, they have you covered there too. They'll take care of you on both sides of the sale. SummitMetals.com. Now back to the psychological impact. That is a real thing. It shows up in trader activities. Investors, they take profits. Capital rolls out. Rally cools off. For physical buyers, though, holding long term, the effect is different. It's more about doubt, whether this run can keep going, whether we'll see gold back above $4,355, whether we'll see silver back above 54.5. So let's lock in a few numbers before we talk about where this could be headed and before we get into what real warning signs of the end of the rally would actually look like. Now, first, gold is still up more than 50% year to date. It jumped over 30% in the 4 months leading into the all-time high, and ETF inflows hit their highest level in 14 years. Now, even at $4,000 an ounce, this is still the strongest year for gold since 1979. Silver is a similar story. 15% drop. That was pretty dramatic, but that came after a run from $29 January 1st all the way to its all-time high of $54.49. That is an 88% rally, and anyone thinking an 88% rally is going to keep running without some kind of volatility, well, is probably watching too much YouTube. With silver hanging out just below that $49 mark, it is still up 67% year to date. So where do we go from here? Is this a dip? Is this the end of the rally? Well, in no way do I think this is the end, but my end of year price prediction for gold was $3,850. And even though we clearly left that number in the dust, I've joked that this year isn't over yet. Half joked really, because I'm not completely ruling that out as a level we could see again, at least temporarily. I'm also not worried about being wrong on a one-year price target because nobody got that right for 2025 using real-world models. This year's price movement has just not followed predictable conventions. I also don't mind if my plans were based on a smaller gain than we're actually seeing now. I would call that a good problem to have. And I'm just going to say that my end-of-year prediction for 2024 looked way off too, at least right up until the very end when it actually turned out to be right on track. Now, what happened last year in 2024? Well, October saw a sharp sell-off, about a 7% drop in gold price from around $2,787 to about $2,560. And that shook a lot of short-term buyers. So if the sell-off we're in the middle of right now seems shocking, you don't have to go back very far to see something similar. Just back to the prior October. Last year's pullback wasn't as sharp, but we know what happened next. We saw a much bigger move up. That's what we've been talking about all year. And that brings us back to today, where we go from here and why predictions even matter. Well, for those of us holding, we are mostly talking about unrealized profits or losses. But that doesn't mean that price forecasting is useless. Price expectations still affect buying or selling decisions. The big question on a pullback like this is always going to be, are we looking at a dip? Or are we looking at something bigger? And that, of course, is going to affect what you do next. So the correction we just saw could be a dip. That's what I think it is, but we could still see more of it. As far as the rally itself goes, though, nothing we've seen so far points to any kind of reversal here. The reason that I say that we could see more of the dip comes down to momentum. To the extent that some of the 2025 rally was driven by fear of missing out, that momentum is gone. Traders aren't feeling like they're missing out at the moment. Investors who are piling into gold for quick gains are not going to keep buying if those gains aren't there. Pretty simple math. That part is clear. If we were looking at this through the analyst lens, well, first, technical analysis shows the support somewhere near $3,830. If you're looking for a how low could it go number, maybe that's one to use. Others would jump down to 3,440. Every analyst has a little bit different view on this, but I'm not really here to do technical analysis. The charts are really only a small part of this story. And just to be clear on the big factor that led to the downturn, the U.S.-China trade talks calmed down. That was a clear start to the move lower for gold price. ETF investors, they also sold off. We saw the largest single-day outflow since May. But from an analyst perspective, the long-term outlook just hasn't changed much. Goldman Sachs is still forecasting gold to hit $4,900 in 2026. Bank of America sees $5,000. JP Morgan has a target of $5,055. All right, now just as a shot of reason here, one of the things that I think has been constructive the last few weeks is that we got a reminder that gold doesn't always go up. None of us are guaranteed gains. Gold has had a huge year, still up 50%. Silver's up even bigger, still around 67%. And a lot of the mining stocks are up considerably more than that. But we really need to keep something straight here. The part that everybody is focused on right now, the performance, the price gains, the charts, the trades, that part of gold and silver and miners is still speculative. It can run hot. It can cool off. Now, I don't feel the value of gold as insurance changes, but the short-term price sure can. Now, look, don't get me wrong. I still think that we go a lot higher, but this is why I clap back on the commenters saying that I'm too conservative. For gold or silver to go hyperbolic, you need lots of buyers willing to pay those prices and very few willing to sell. I've just never experienced that. And the reason for that is pretty simple. A lot of people are going to be ready to lock in a 60% gain on an asset that typically gains closer to 6% a year. It's just how investors operate. Gold and silver are not new. This isn't GameStop or Bitcoin. Price discovery has been happening for centuries. It's just reality. And that's why I don't expect a rally like this to go straight up. I did already say here, though, that I think we continue to go higher. I don't think the rally is done. At least nothing tells us that it is. I think that we're going to have some clues, though, telling us when we get closer to it. I'm going to give you 6 to watch for. The first is ETF flows. So when inflows slow down or they turn to net outflows, even while the price is going up, it's a signal. It means investors don't want it at these prices. Now, second, it's pretty similar, but now we're talking about central banks. Right now, central banks are net buyers. Nearly a third of annual gold production gets locked up by central bank demand. So we've seen that has been massive support for price. And if it ever flipped to net selling, well, I would take that as a serious warning sign. Now, those two are about data. Third would be retail demand. And this is a lot harder to measure with gold because most of what we hear is going to be anecdotal. Dealers I talk to have not seen buyers backing off, but I've heard other people on YouTube say the opposite. So who do you listen to? Well, if you just go off feeling, a lot of us have probably been more hesitant ever since gold crossed that $2,000 mark. And we tend to hear what we already believe. So if we already feel that gold is expensive, we're going to believe those stories of buyers being scared off. That's just good old-fashioned confirmation bias. Now, fourth is futures positioning. When managed money longs pile in, commercial shorts build at the same time, that's usually the final phase before a reversal. Now, look, that's a lot of jargon. I'm not good at explaining jargon, but if you do know where to look, it's one of the clearest signals to watch for. Fifth is a lot easier to explain. This is when the news is saying that you have to own gold. When Cousin Eddie and Aunt Edna are calling you to make sure that you're in, this is when everybody seems sure that it's only going higher. And it's not confidence, it's euphoria. And that's usually a good signal that the party's over. And then the last sign I have for you, there are probably more, but when the Fed starts talking about confidence, when they start using words like stability or excessive speculation, well, that means they're seeing the same overconfidence that everyone else is. It probably means Jerome is getting those same calls from Cousin Eddie too, and they are going to be one of the last signs that the rally has gotten too hot, because the Fed looks at lagging data. So if they're talking about it, it's already been happening for a while. So hopefully by the time they're on TV talking about overconfidence, we'll already know. So where does that leave this whole thing? Well, I still think the rally has more room to run, but this is a good reminder that gold and silver aren't lottery tickets. Nothing we've talked about says the rally is over, but we're also not entitled to a moonshot. Gold doesn't owe us anything. Silver definitely doesn't either. If this pullback shook you up a little bit, well, maybe that isn't a bad thing. Maybe it's just a reminder to pay attention, to look for signs, so we can tell the difference between a dip and something bigger. I've never thought this was about predicting exactly how this is all going to go down. It's been more about knowing what we're looking at as it happens. And let's call it good there. Let us know what you think. Is this the dip that you've been hoping for? Or is Cousin Eddie already onto it? Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.